Ladies and gentlemen, on behalf of the Law Society, I'd like to welcome you to this seminar, our first attempt really at dealing with the area of the use of financial statements in legal transactions. In order to deal with this topic, we've gathered a number of the people who perhaps know best about how to use and deal with financial statements, the chartered accountants. And in particular, I'd like to introduce the program leader, Peter Mashinter, who is a chartered accountant at Clarkson Gordon. Peter joined Clarkson Gordon as an audit staff accountant in the mid-1960s, and since then has been providing audit accounting and tax services to many small, medium, and some large corporations. He is currently the manager of the business advisory group at Clarkson Gordon, and in that capacity he manages a staff of professionals providing a full range of business advisory services to approximately 60 small and medium-sized businesses in many industries throughout the province of Ontario. He has designed and written, as well as presented seminars to many owner-manager groups on various business and taxation topics. And Peter has organized the program and has gathered a number of his colleagues from Clarkson Gordon who will be, along with Peter, conducting the program. And I'd like to call on Peter to introduce the first speaker to you.
Good morning. I bet you're all thinking that I look very young for saying I started in the profession in the 60s. Actually, despite my gray hair, I started in the profession in 1976. And I am a manager in the business advisory group with Clarkson Gordon, the Toronto office. We deal principally in owner-managed companies, and that's principally what we'll be talking about all day today. With me is Lou Meehan. Would you like to stand up, please, Lou? Lou is a recently appointed audit partner in our Toronto office. Lou worked with me for the last 4 or 5 years. We've worked together in the business advisory group. He also lectures at the University of Toronto and on several TV programs from time to time. I thought that this morning was his first appearance, public appearance as a partner, but he informs me, no, he was on TV 2 or 3 days ago lecturing on similar topics. Also with me is Bill Crawford. Bill, would you like to stand up, please? Bill is well experienced on the lecture circuit. He's a tax partner with Clarkson Gordon. He's been a tax partner for 12 years. So I guess that means that he started in the 60s rather than myself. And Bill is the fellow that you want to get going this morning and this afternoon, because he's excellent at joke telling. So prod him on, applaud his performance, even if it is poor. And if you get him going, then he'll appreciate back with lots of jokes. He's very good in that department. Not bad at tax either. He told me to tell you that if you're wondering why a tax partner is speaking on valuations, that he has some first-hand experience in that he was an expert witness in the Supreme Court of Ontario on a valuation matter, and I'm sure he'll tell us a little bit about that as he gets rolling this afternoon. This session revolves around the case study that you've all received, P Trading. And P Trading is a case study that was written in Vancouver by one of our partners in Vancouver for the Vancouver Law Society, or for the BC Law Society. And that case we've used here because we think it fits in well with the package which we're going to present to you. First of all, we're going to be talking about understanding financial statements, the principles and concepts behind financial statements, generally accepted accounting principles, and Lou will be talking to you about that. At 10:30, we're going on, and I will be talking to you about P Trading Company and how I would read P Trading Company if it were handed to me cold to analyze. At 11:30, we'll be moving on to Bill's business valuation techniques and the related income tax implications. And we will again be taking P Trading, showing you several approaches to evaluating this company and how the income tax implications would impact on the value of the company. And Bill will be taking those sections. So I think now we'll call on Lou, and Lou can lead away with the section Understanding Financial Statements.
Good morning. As Peter mentioned, my part of this morning's presentation is reading financial statements. Statements are really a brass tacks communications vehicle between businessmen. People are in business for really two objectives. The first objective in any business, even a startup, is solvency. If you can't pay the bills today, you won't be around tomorrow. The second objective, and probably the complementary objective to being solvent, is the profit objective. So if statements were to do anything, they will speak to you about the solvency within a business and the profitability of the business. Now, in measuring profitability, you really have to make some arbitrary decisions. I have a client with $100 million of sales, and he says that he buys for $2 and sells for $4, and that 2% difference really adds up. And that's really a measurement of an income item, and there's several ways of measuring income. In the old days, they used to look at it on the cash basis. Then accountants came along and said, gee, why don't we create a profession, create some very complicated rules, create some allocations, and we'll have an industry all to our own. Nobody will understand what we're talking about, and that way there will be the industry there for us to explain what's going on. But really all statements ever talk to is solvency and profit. And then from the solvency of a business and from its profit, you can make some, you can extend some, you can make conclusions about what you think about the business. But statements don't pretend to be everything. The statements that chartered accountants use, the statements that are acceptable to all the securities exchanges, are based on allocations that are not necessarily logical. They certainly aren't complete in that they're very old rules, they're historic cost rules that were developed over the years. They don't speak to current value, they don't speak to what the consumer price index is doing, and statements can go a long way to evolve. Now, in the index, I talked about statics, dynamics, and integrity. When I talk about statics, I'm really talking about the balance sheet. A balance sheet is a statement at a point in time where you take a picture of where a business sits. On the balance sheet, you look to the current assets, those resources that are available to pay bills, and you look at the current liabilities. Those are the liabilities that in the normal operating cycle have to be met. You would hope to be solvent that your current resources were greater than your current liabilities. It also looks to the equities that the owners have in the business. It looks to the long-term financing in the business and the assets other than current. So it's a picture. It's a static representation at a point in time of where the business is. Dynamics, that's the allocation, the measurement accounting that we use through the income statement. Now, it's a measurement. How well did we do? Let's define a set of rules and measure how well we did. Let's compare how well we did to the industry we're in. Let's compare the industry we're in to other industries so that we can have a rational securities market and everyone can judge through a bunch of conventions how well businesses are doing. The integrity really speaks to the fit. I think it goes back really to your grade 11 physics where you learned that energy can neither be created nor destroyed. In the last 5 years, there was a major clothing company that was sold in the Toronto area to another group of people in the clothing business. And after the people that bought the business ran the business for a year, things didn't seem to make sense. And what had happened was gross margins had dropped off drastically. And it really goes back to the opening inventory, the position that they bought. It wasn't right. When something's not right in a statement, it falls out. Your gross margin is the amount of contribution you get after you've paid your direct material costs. And that your direct material costs, or your cost of goods sold, is a relationship between your opening inventory, your purchases, and your closing. If one of those numbers is wrong, then something's going to look funny in the end. You're not going to get the results that you budgeted for. And in that case, they certainly knew what their purchases were because they were running the business. They knew what their closing inventory was because they attended it themselves, counted it, and priced it. So the error had to be in the opening inventory. And that's what I mean about integrity of a set of statements. There's no way that you can sort of meet the old adage, well, what do you want it to be, and make it what you want, because it'll come home to get you in trouble at a later date. All right, now a balance sheet can really be represented by a square. Obviously, you've got assets, liabilities, and owner's equity. And any transaction on a balance sheet really affects one of the other components within the balance sheet. Now, because we have to worry about solvency, accounting has designed current liabilities and non-current liabilities. Now, current liabilities are liabilities that have to be met within the operating cycle of a business. Well, the Tax Act and trading in industry has defined an operating cycle to pretty well be a year. If I just cut the power off, John? Yeah. It got pinched in the desk. I'll speak loud until he can fix it, John, okay? Fair enough? Sounds better? Is it, well, if it's better without it, let me just try that for a while. Now, current assets are those assets that are available to be realized within a year. Certainly cash on hand, you can take that to the bank and they'll recognize that any day of the business week. Inventories, you would hope that you wouldn't have a year's inventories on hand, and if you sell them within the year, they're available to meet your debts. Accounts receivable, if your normal trade terms are 30 days, those are available hopefully within 30 days to meet your debts. So the difference between your current assets and your current liabilities, we call that working capital. And that certainly is the lifeblood of a business. Its ability to carry on. That's solvency. That's what you would look for in a set of statements. That, to me, is the primary objective. So the balance sheet, then, is really a representation at a point in time of the statics. Okay? Now, the key between the income statement, where you have your revenue and your expenses, is the owner's equity account. Yes? Would I use what? Sorry, Peter? This one? Okay, I'll move it over. The dynamics are measured through the income statement, the revenue minus the expense. And hopefully, I'll use pi as a symbol of the profit. That profit fits into the balance sheet through the retained earnings account. Now, the retained earnings account in a business is represented by the original capital that the owners of the business, the profit that they've made in the business, hopefully buying for 2 and selling for 4. Owner's equity will give you the fit of the balance sheet, the integrity of the balance sheet. And the fit between the income statement and the retained earnings is through the equation of opening capital the amount invested in a business, plus the profit, less the dividends, equals your closing capital or your closing owner's equity. Fair enough. Now, the world went on and said that, great, it was fine to measure where you were at a point in time. It was fine to have a set of arbitrary rules that measured income, but a lot of people saw businesses that were making money that were always cash hungry. And certainly that's the case in Canada in our resource companies. If they have sales of, say, 100 million and expenses of 80 million, they've made 20 million. However, if each year they have to plow 40 million back into the oil fields, they're perpetually short $20 million each year. So the business community needed another statement. And that statement is the statement of changes in financial position. And when you're buying and selling a business, the business's ability to generate funds is an important measurement of its ability to stay solvent. Certainly if you're making 20 million a year and needing to spend 40 to stay in business, you're perpetually going to be hungry for cash. Now, the easiest way to look at the statement of changes in financial position is again to look at the balance sheet. On the balance sheet now, we've made 5 categorizations. We've got our current assets, current liabilities, non-current liabilities, owner's equity, and our non-current assets. And we'll remember that the assets have to equal the liabilities plus the owner's equity. All right, now the business can represent its working capital by that segment in the box between current assets and current liabilities. So it becomes very important to measuring the dynamics of a business to know the movement on the balance sheet between working capital and all other areas of the balance sheet. If the owners inject capital into the business, it's a positive change in their equity, it's a positive change in the working capital. Certainly to a bank, that's an important dimension of a business going forward. If a business buys a building, the building is certainly a non-current asset. If they buy it with cash, the working capital shrinks. If they buy it with a mortgage, the balance sheet has grown equally. Certainly that would be successfully levering yourself. You've grown through using other people's money. If a business takes a dividend out, owner's equity shrinks, and the dividend normally is cash, and that means the working capital shrinks. So measuring how a business is prepared to go forward, certainly you need the profit gauge. Profit adds on to owner's equity, and it adds on to working capital. However, you also need to know what the business needs to stay in business. And hence I go to the example of the Imperial Oils, where they need to spend $40 million after a profit of $20 million to stay in business. So the third statement, and the statement that's becoming increasingly important in a set of financial statements, and certainly the understanding of it is becoming more and more important, is the statement of changes in financial position. All right, now, let's take a minute and summarize bookkeeping. In a business, the first thing you have to have is an economic event. When I phone up one of my suppliers and order 100 cars to be delivered in 3 months, yes, I have an economic event, but nothing's been performed under the contract, so I don't really have something that I want to measure. If Eatons have shown up in the back of my plant and just delivered 5 new desks, certainly they've performed under the contract. I don't have to pay them at delivery, but I do have an economic event that I have to measure. So the first thing in the progression of doing a set of statements is recognizing what economic events need to be recorded. The second phase is to create a record. If you make a sale, you usually strike up an invoice. If you're paying a bill, you need to write out a check. If something has arrived at the back of your plant, you normally have a receiving report, so you've locked in your purchases. Certainly in a law firm, the key record has to be your weekly or monthly time reports. If you don't know where you're spending your time, and if you're not locking that into the system, you really don't have the proper records. And the next phase in the development of records is what we call the journal. Now, the journal is nothing more than a chronological collection of all of those records. All of your time reports end up in a fee journal. All of your checks end up in a disbursement journal. Similarly, invoices end up in a sales journal. So let's remember that that journal is chronological. Then you have to sort your records to understand what's going on. And the way that we sort records is that we post from a journal to a ledger. And a ledger is nothing more really than a journal that's been sorted by type. So once you've got the ledger, you then adjust it. Some things, some economic events don't happen automatically. When you have incurred huge legal services for a reorganization, the bill might not very well have been rendered by the time you have to take off a statement. You don't have a receiving report for a legal bill. You don't have a disbursement yet because you wouldn't pay the lawyer before he billed you. So you have to look at the ledger and adjust for expenses that you've incurred but haven't paid, or revenue that you've earned but haven't received. So then you adjust your ledger and you take off what we call a trial balance. Now, from the trial balance, you can create a set of financial statements. And then from the financial statements, you can take some action. Either, if things are very good, you can reward the people who have participated in the contribution, or if things are sorry, you can make some very quick adjustments. So that's really the fit of a set of records. So far we've looked at the statements and how they fit with one another, and we've looked at records and how they come together to produce a set of statements. Now, we talked earlier about, the income statement being really based on allocation accounting. Now, allocation accounting has developed over the years, and in some areas it's still evolving. In the last 10 years, there were businesses that thought they could do what we called off-sheet financing by using assets through lease agreements. They thought, well, gee, we don't have the debt on our balance sheet. That looks more favorable to the bankers. Let's lease what we can and only pay currently for what we use. Well, accountants said, gee, the balance sheet then doesn't portray what's going on. Let's look at leases and see if they are capital, meaning just like a purchase, or if they're operating and they truly are just a day-by-day expense for the use of an asset. So issues in accounting have evolved. However, they've evolved around a framework, and that framework is what we call generally accepted accounting principles. The first generally accepted accounting principle, and let me say, this isn't like Deuteronomy. It's not in one section of a Bible somewhere. The handbook really doesn't even talk about generally accepted accounting principles. They just sort of evolve over time, and depending on the emphasis of the accountant, he might say there's 13 of them. I think I've listed 10 of them. But I think within the framework of the 10 that I might give you, you'll have a very good grasp of the underlying foundation of the rules that make up the handbook and the disclosures within a set of statements. The first thing you have to look to is the entity. What are we talking about? If we have a group of companies with a common ownership and they operate in different segments of an industry, by incorporating a company every time they go into a different industry, should we just look at the little corporations? Are intercorporate accounts important? Or should we look at the economic entity? In Toronto, in the last 15 years, there was a major public company that was vertically integrated in an industry, and they consolidated everything but the retail outlet. The retail outlet was a loser. So the statements really didn't portray a true picture of what was going on in the economic entity. All they'd really looked at was the legal entity. So within the entity theory and generally accepted accounting principles, you have to distinguish between the legal entity, the company itself, and the economic entity. All right, and when we talk about the economic entity, we're talking about consolidating subsidiaries. The next one I think that you should look at is the going concern principle. If I'm in the business of making headlights for Forenzas, and the Forenza was discontinued from General Motors lineup, that headlight has a diminished value because it's not an ongoing product. You assume in generally accepted accounting principles that the product that you're making, although it might be one piece of a larger construction or a larger component, you assume that the thing has value. You assume that its end use will continue on. The going concern is very important. In liquidation, I think the bank's experience has been that they get about 15 cents on the dollar on inventories. So the ability to sell the inventory, the ability of the company to continue, is very important in your measurement of certain of the aspects of a balance sheet. The next one, the next generally accepted accounting principle, I would say is the periodic principle. You have to define the period that you're looking at. If you don't have definition of the period, then you'll be mixing apples and oranges. In the TV industry, you'll find that most of their year ends are August. The year ends are August because that's when the viewing programs change. That's when a season is naturally over. And if you were going to compare TV stations and how they were doing, you would hope to have common periods, because the height of their season is through the fall and the winter. And if you were comparing a company that had a December year end with a company that had an August year end, you're looking at different cycles, and that's probably not a very fair measurement. So your period has to be consistent, both within the company year to year and within the industry company to company, and probably industry to industry, particularly when we were going through heavy inflation in the last 5 years. The next principle would be objectivity. You can't make money dealing with yourself. If I make those headlights and they cost me $1 and I can sell them for $2, I really haven't made the $2 at production. I've made the $2 at sale. It's sort of the arm's length third-party realization principle. You have to be objective. And the next one is you have to define your monetary unit. Now, accountants in the last 10 years have had a very tough time defining the monetary unit. The biggest shortfall to me on a balance sheet is that fixed assets are at historic cost. If you bought a plant 20 years ago, if we look at the consumer price index, today's dollar goes probably a third of the way of where it did, say, 10 or 20 years ago, then that plant, in terms of replacement cost, is really understated on your balance sheet. So the issues that accountants have to address within the monetary unit is whether you use the old historic dollar, which we seem to use now, whether you use a current dollar by fair valuing every asset on your balance sheet, or whether you take an index and work it through all your numbers. Now, an index might be that the consumer price index in 1971, if we said it was 100, right now it might be 225. Well, that would mean that you marked up all of your 1971 assets by a restatement factor of 225%. So you have to make sure that the monetary unit and the statements you're using is consistent. All right, now that gets me to the next one, and I won't spend much time on it: consistency. The measurement from year to year has to be the same. In inventory, you've got the dilemma of which goods did you sell first? The ones you bought first, the ones that were on hand, or an average representation of all of your inventory. And if you're going to compare your business from one year to the next, you have to be consistent in your determination of the inventory. The next generally accepted accounting principle that I'd have to say is disclosure. You have to disclose whatever makes sense to a reasonable third-party reader. What type of information does the reader need so that he can make a fair judgment on the statements? You have to have adequate disclosure. The next gauge I might use is materiality. Materiality, why tell them something they don't need to know? Every day in the United States, they make 90 million cans of beer. Well, that doesn't tell you very much, but if you know that every other day someone in the States drinks an average of a can of beer, that might tell you something. So you look to materiality. In the determination of income, accountants have had to set some very arbitrary rules, and what they've said is that normal pre-tax income, 5 to 10% of those expectations it's a fair degree of materiality, meaning that if you disclosed an income statement to someone and the sum total of all of the errors in there going every way didn't result to anything more than 5 to 10%, depending on the company, then really those statements are fair. If your neighbor says to you, how much do you make a year, and you tell him you make $100,000 a year, probably his assessment of how much you make wouldn't change if you said 105, 95, or 90. So the materiality gauge that we use is around 5% of the number that you're talking about. The next one is conservatism. And that's simple. Don't count your chickens before they hatch. It's the old realization concept, and I won't spend time on that. And if I had to say there were 10, I think the next one I would just say is matching. Match your revenues with your expenses. If you have a painting department in your shop, make sure that the cost of the painting department follows the product and not the period. Meaning that if the paint shop costs $100 a day and they make 100 products, each product costs $1 to paint. Don't take that $100 and write it off just because the men worked a day. Attach it to your inventory. So within that set of generally accepted accounting principles, you normally can make a fair judgment about a business transaction and a set of statements. Okay, so we've looked at statements, we've looked at record keeping, and we've looked at generally accepted accounting principles. Now the other two items that I want to address today are, I want to talk a bit about deferred income tax, which really is a third-year university, almost a full-year level course. It's an area that hasn't been resolved in the accounting literature, and they're looking at currently. And I want to say a bit then about intercorporate investments. There's no real solution to the deferred tax question in the accounting literature. England does something very different than we do in Canada, and we do something as chartered accountants very different than the businessman thinks in his mind about budgeting. We talked about matching earlier of revenues and expenses, and that's really what deferred income taxes try to do. They try to match a representative tax rate with an earning stream. Now the businessman doesn't think that way. The businessman says, gee, if I continue to buy physical plant, if I continue to expand, I can put off my taxes by depreciating new assets. So in the mind of the businessman, we have taxes really on a cash basis, but in terms of a measurement model, we have taxes on a matching basis. And therein really lies the whole quandary. The handbook, the Canadian Institute of Chartered Accountants handbook, says, thou shalt deferred tax account. Well, when you're buying a business, I'm sure you look at it just on a cash stream, and those deferred taxes, should you continue to go on, they really get plowed into the future. Earlier I talked about the resource company that had earnings of $20 million and had to buy $40 million worth of physical plant a year to stay in business. Well, if that physical plant can be written off at the rate of 50% of that new 40 is 20, and that perfectly protects the $20 million of income that you have every year. And that's what David Lewis was getting at when he talked about the corporate ripoff. I don't really think it's a corporate ripoff because that plowing of funds into fixed assets and expansion, really there's a velocity to it and it accelerates through the whole economy. But I'm going to take a numeric example now and show you the quandary of deferred income taxes. What I want to do is I have a company that's going to make $120 million for each of the next 3 years. And they only have one asset that they bought, and it cost $120 million. So our time horizon is year 1, year 2, year 3. The business makes $120 million in each year, and the plant that it bought for $120 million is only going to last 3 years. Maybe they make Pope plaques or something, and they knew the Pope was coming to Toronto, and they knew the production cycle was only 3 years. They had 3 years lead time. So generally accepted accounting principles, the matching concept would say, take your plant and amortize it over the life of the plant. The life of the plant is 3 years. The expense will then be 40, 40, 40. It's pretty simple so far. That would tell me you made 80, 80, 80. Now, if you phone up your CA, Bill Crawford, he tells you, well, if you're making that kind of money, you better accrue taxes at 50%. So then you put in a 50% tax rate, and you got 40, 40, 40, and you're left with net income of 40, 40, 40. CAs hate change. They think that's nice and smooth. They know nobody gets upset if things really don't change. So that's the way that they would like to report income if you had an earnings stream of 120 per year before depreciation, and you had a $120 million asset that got you that earnings stream. Take your asset, smooth it out over the 3 years, determine your income, and then take your tax provision to come up with your net income. All right? Well, then McKechnie and Lalonde and Chrétien and Trudeau and everybody came along and said, no, if people are buying physical plant, they're stimulating the economy. And we're going to give them a write-off for that physical plant that they bought that has absolutely nothing to do with what accountants might tell them to do with it. And let's say that we'll forget the half-rate rules and all of those crazy little changes that they've made. Let's say that this is a manufacturing asset and it can be written off over 2 years. Well, then on your tax return, you're going to start with the same 120, and you're going to have 120 in each of the 3 years. However, you're not going to be a fool. You're going to take the deductions that are available to you, and you're going to write off the $120 million plant in the 2 years that you're allowed to write it off, because you want to minimize your taxes. Otherwise, you're not going to help your solvency, you're not going to help your profit. So what are you left with? Well, for tax, you're left with 60, 60. In the third year, you have no protection, so you're left with 120. If you're in a 50% tax bracket, the taxes are 30, 30, and 60. Well, the tax bill up here in accounting, 40, 40, 40, adds up to 120, half of the 240 that you made, so the matching seems to be fine. Down here on your tax filing basis, your taxes add up to the same 120 on the same 240 of income, but look what you're left with. You're left with 30, 30, and 60. So somebody says, well, the matching doesn't seem to be right. Well, out on the street, the businessman thinks like this. The handbook thinks like this, because they really like the matching principle. So how do we get the two together? The two are brought together by something called deferred taxes. If I want to end up with a provision of 40 on my income statement when I'm only paying 30 of taxes today, I better put up 10 of taxes for the future. If in year 2 I have an accounting provision of 40, I'm only paying 30, I better put up another 10. So that in the year when the 60 is due, I have the 40 that I normally would have, plus this 20 to give me the 60. All right? During the first 2 years, we were accumulating deferred taxes. During the third year, the deferred taxes reversed. And therein lies the whole quandary. So are deferred taxes a liability? I don't know. You tell me. When would they come due? They would only come due if you ceased to expand. When are you going to cease to expand? I don't know. Your business would be mature then. So if you were looking at the business, you really would be very concerned about the time horizon of the deferred income tax balance. When you're measuring the business's solvency, you better know whether the deferred tax items are current, meaning they will reverse next year, or whether they're long-term. If they relate to fixed assets, they're long-term. If they relate to, say, an insurance broker who's allowed a reserve for his unearned premiums, you know that they reverse every year. And if the fellow, for 1 year, winds down his business a bit, then the taxes are going to start to come due. All right, now, the difference between capital cost allowance and depreciation is called a timing difference, because you can only write off 100%. You have to write off 100% at some point in time. The only difference is timing. So deferred income taxes account for timing differences. The only other aspect in the calculation of deferred income taxes is that you have to isolate permanent differences. In business, it might be very prudent for your 5 vice presidents to take $10,000 a year and have club memberships. 5 times 10 is $50,000. Club memberships are not, or the annual dues, are not deductible. So you've got a legitimate business expense, but it has no tax recognition. That's a permanent difference. There's no recognition for it in the Act, yet there's recognition for it in an income statement. So you must isolate those permanent differences and the timing differences, and deferred taxes only relate to timing differences. Now, I won't go into deferred taxes much more deeply, but here we're setting up a credit for the future. What happens if the deferred taxes go the other way, where we have write-offs for accounting that don't have tax recognition today? Maybe they'll have recognition in the future. The first year in business, you lose $800,000. Well, we all know that if you lose $800,000, you normally should have protection against your first $800,000 of profit, because reasonably the Tax Act would say you're flat. Well, is there a benefit then to the loss of $800,000? In a 50% tax system, is that benefit worth $400,000? Well, you don't file your tax return for a year, so you'd think you might discount that $400,000. You might say that in logic, but that isn't what the handbook says. So the handbook is full of problems in deferred taxes. What rate do I use when I do my deferred taxes? Do I use the rate of the Grossman tax holiday here in Ontario, or do I use the rate when I think they will reverse? So when we got into allocation accounting and when we got into deferred taxes, it became a very complicated world. And there really is a very strong movement, and certainly the Institute's doing a research study on it right now. Let's get rid of it. It's too complicated. Well, I don't know that I agree with that. I think we do need allocation accounting, and I think that the easiest way to correct for the peculiarities of deferred taxes is to look at your statement of changes in financial position. The statement of changes in financial position undoes deferred taxes. In the statement of changes of financial position, you take your net income from the business and you adjust for things that you've accrued that you don't need to pay for within the operating cycle. So you really can determine how much the business is generating outside of the deferred tax accounting. Okay? Any questions on deferred taxes, if you want me to stop there for a minute? Fine. Okay, now the next segment that we're to talk about is long-term investments. Now, what we're going to talk about really didn't exist in the literature, say, 20 years ago, in terms of arbitrary rules for accounting for what we might call long-term intercorporate investments. Now, we have the cost method of accounting. We have the equity method. And we have consolidation. I guess that's an S. And then we have something called proportionate consolidation. In the cost method, we're normally talking about portfolio investments. You go out and take a position in Noranda, you go out and take a position in Weston's, you know damn well you'll never have control of the business, you know you have no significant influence, you send in your proxy and they just add it to the way the majority's moving anyways. So you really should only account for what you have a right to receive. So in the cost method of accounting, you account for your original investment at what you paid for it. And that'll probably be cash. And then you only pick up your dividends. The only right you have as a shareholder, really, other than to vote, and you know you won't get control, is the right to receive dividends once they're declared. So in the cost method, you pick up my convoluted cash there as the balance on the balance sheet, and you pick up dividends as they're declared and take them up in your income statement. All right, now what's the equity method? Well, the equity method says that you should pick up your equity in the earnings. So what do? You start with your cost, and you pick up your percentage of the profit less cash that you've received. If I spend $80,000 on an investment, and I own 20% of it, and they make 100 million, well, not 100 million, maybe they make 100,000 the next year, I have an equity of 20% in that 100,000. So my carrying value on the balance sheet would be the 80 that I paid for it plus the 20 that's my equity. Now, if in the next year they paid me 5, my equity went from 80 plus 20 to 100. They paid me 5 in cash, so my equity is really then reduced by cash payments to me. So that's the equity basis of accounting, and I'll talk about where you use these in a minute. Now, the consolidation theory really says that, yes, you have several legal entities here. You might have an ultimate parent, a parent, and a subsidiary, or you might have several subsidiaries, but they really are separate legal entities, but economically, they're really run by the directors of the ultimate parent. So what we want to do is put all the companies together as if they were one entity, right back to generally accepted accounting principles, where I said that the entity theory was important. You wouldn't represent how well a business was doing by leaving out one of its subsidiaries. You have to look to the whole economic entity. All right, now in consolidation, you pick up 100% of the balance sheet, you pick up 100% of the income statement, and you pick up 100% of the statement of changes in financial position. Well, to have a subsidiary, it doesn't have to be wholly owned. To have a subsidiary, all you have to do is have legal control. Legal control is usually better than 50%, or the right to elect a majority of the board of directors. You could have control through a very well-written shareholders agreement. But there still is a minority interest, what we call a minority interest, in this subsidiary. So how do you account for it? Well, you account for minority interest as sort of a pseudo-liability. And you take up 100% of the sales from the sub into your results, pick up 100% of all of the expenses, then determine their equity in that income statement and one-line it. On one line on the income statement, deduct out the minority interest in those results. And then on the balance sheet, your balance sheet, where you've picked up 100% of the subsidiary's assets and liabilities, put up this quasi-liability called minority interest. So then you have the whole fit of the economic entity, and you have accounted for the minorities. You're saying that you really control it, so all of the results accrue to you net at book value to what you owe the minority. All right, now there's another animal called a proportionate consolidation. Certainly in Canada, we have some very big real estate companies, and real estate typically tries to spread its risk. There's lots of ventures around where pieces of the action are up for grabs, and the big boys go around and try to spread the risk by getting pieces of action in every town around. To spread the risk on, Houston had some problems when the oil economy turned down. Calgary had problems when the oil economy turned down, so they try to spread risk. So proportionate consolidation is very appropriate in the real estate industry because spreading risk is a major part of the way the industry carries on. So what you do in proportionate consolidation, where joint ventures are very significant to the conducting of your business, you pick up pieces, you pick up your pro rata share of all of the pieces that you've invested in. So rather than picking up 100% and throwing up huge minority interests, you just pick up your pro rata share of all of the pieces of the joint venture balance sheets. All right, so those are 4 different ways of accounting for long-term intercorporate investments. When do you use them? Cost, certainly when you have no influence. Equity, you normally use equity accounting somewhere between a 20% interest and a 50% interest. All right? Consolidation, you have to have a legal subsidiary to consolidate. And when do you proportionate consolidate? When it's appropriate to your joint venture interests, when it's appropriate to your industry. Okay? Now, the last part that I want to talk about relates to the case where we had the parent and the sub. We had a sub, and they appropriately called it S Company, where the assets minus the liabilities gave you a net book value of 60. Well, what did they pay for the sub company? You'll find in the case that they paid 100. So their investment in the parent equals 100. Well, you'd say, why would anybody in their right mind pay 100 for something with a net book value of 60? Well, they're buying the business based on expectations. I would hope that you're not enamored with bricks and mortar and you really buy a business based on expectations. You don't buy a business necessarily based on just its balance sheet. So here we have a company that's paid 100 for a sub with a retained earnings of 60. Well, you know that if you add up all of the pieces of the sub, you're going to get a net book value of 60. And when you pick up all those pieces, that 60 has to go against an investment of 100. So all of a sudden, you've got a problem. Well, what do you do with the problem? You've paid 40 more for something than its net book value. You're going to have a problem with fit. Well, what you do is assign new values to the assets. Assign the values that you think is appropriate at the date of purchase. In the case, they said that the fair value increment for fixed assets was 20. So of a discrepancy of 40, if the fixed assets really are bought in a prior period and historic cost has diminished them in carrying cost when fair value would say they're worth a lot more, let's assign a piece of our discrepancy to the fixed assets up to the level of what they're worth. Now I want to come back to that in a minute. So we're still left with 20. We've got 20 of a cost of an investment, and we have no assets to put it against. Well, that's quite easily called goodwill. What is goodwill? Goodwill is the excess of the purchase price paid over the fair market value of the net tangible assets acquired. So let's go back over that. Goodwill is the excess of your purchase price paid over the fair market value of your tangible assets acquired. Fixed assets are tangible. I can assign a modern value to them. I can assign a current value to them. I'll get an appraisal in if I'm buying a plant, and I'll write the plant up to what it's worth. There's still a plug number left. That's my goodwill. How do you justify goodwill? Well, if goodwill's 20 and your expectations after tax are 20%, you better hope that there's a pure profit of, say, 4 that would capitalize and give you a goodwill of 20. So that's really how you'd look at it. if you start having a few bad years, you better look at the carrying value of your goodwill, because maybe it's diminished. Maybe the reasons why you bought the business have now evaporated. All right, now the only, the one point I want to come back to is the fair value increment in fixed assets. If we, and I forget the numbers from the case, have fixed assets that have a tax value of 40 and an accounting value of 40, and currently they're worth 60, and we ascribe 20 to get the fixed assets on the new balance sheet, the consolidated balance sheet, from 40 up to 60, we have to remember something, and that is that 20 between 40 and 60 has no income tax recognition. So if I go out and buy a plant that's worth 60, I'm probably allowed to depreciate that at 5%. 5% of 60 is $3,000. If I've bought a subsidiary with a plant on the books at 40, I still can only depreciate that 40 at 5%. 5% of 40 is 2. So I've lost the tax value of this fair value increment. It's a little tricky. So when you buy a business and you write up the fixed assets, you have to discount that writing up to the appraisal by the non-existence of any tax value of that increment. And I think at that point you better call in your CA, and maybe at that point I'd be glad to take some questions. Okay? Any questions on, that's first year BCom, third year BCom, and 2 fourth-year subjects we've just covered. Anybody? Well, I'll be around throughout the day if there's any questions. Do you want to move to coffee now, Peter, or how do you want to do it? All right, we'll take a coffee break, and by my watch, it's 10:12. When do you want to come back? 10:30? All right, we'll break till 10:30. Thank you.